Good morning. Oh, good afternoon, I should say. I'm sorry. As the MRAC designated federal officer, it's my pleasure to call this meeting to order. This is Alicia Lewis. Before we begin this afternoon's discussion, I would like to turn to Commissioner Rustin Benham, MRAC sponsor, and Nadia Zakir, MRAC chair, for opening remarks. Commissioner Benham.
Thanks, Alicia. Good afternoon, everyone. I want to thank everyone for taking the time to meet. We're having a telephone conference this afternoon because we have a few limited items to discuss and thought it would be worthwhile to have a conference call instead of an in-person meeting. Quick thanks to Tom Whiff as chair of the subcommittee, and Ann Battle and Aga Mirza as well, and Dennis McLaughlin for their participation today. And a special thanks, of course, to Alicia Lewis and Nadia Zakir for their long-standing leadership and organization for this meeting. We're starting to sort of produce some results, and rubber's hitting the road here as we lurch towards 2021. And I love the subcommittees and the work streams are working towards a lot of deliverables and results. So continue to look forward to seeing the work product from the subcommittee. It is playing a huge role in the larger transition away from LIBOR. And as I go around the country and travel as well at conferences, I think the MRAC's work is being recognized in a very positive light and doing a really important job in contributing to the larger task at hand that the ARC and other organizations are leading. So thanks again to everyone. Look forward to this afternoon's discussion and future discussions as well. Thanks.
Thank you, Commissioner Benham. Chair Zakir.
Thank you, Alicia. As Commissioner Benham noted, today's meeting is being convened at the request of the Interest Rate Benchmark Reform Subcommittee to discuss a number of developments involving LIBOR transition. In particular, the Interest Rate Benchmark Reform Subcommittee was formed in September 2018 with the objective of providing reports and recommendations to the MRAC and ultimately the Commission regarding ongoing efforts to transition U.S. dollar derivatives and related contracts to the Secured Overnight Financing Rate, or SOFR, and the impact of this transition on the derivatives market. We are pleased to welcome the members of the subcommittee today to present their initial recommendation regarding the adoption of plain English disclosures for new derivative contracts referencing LIBOR and other IBORs, and to discuss other key developments in the LIBOR transition, including proposals from central counterparties regarding their respective price alignment transition plans and clearing treatment for physically settled swaptions. Thank you to the members of the subcommittee for your work on this important issue. Thank you to Commissioner Benham and to the Chairman's office, Commissioners Stump, Quintens, and Berkowitz for their participation on today's call. Also, thank you to Alicia Lewis and the CFTC staff for their hard work in organizing this teleconference meeting. Turning to the agenda, before we begin, we would like to do a roll call of the members, speakers, and CFTC commissioners on the phone so we have your attendance on the record. After Alicia says your name, please indicate that you are present.
Salma Benai.
Present.
Stephen Berger. Lee Betzel, CME.
Present.
Isaac Chang, AQR Capital Management. Biz Chatterjee, Citigroup.
Present.
Alicia Crichton, FIA.
Present.
Matthias Graulich, Eurex. Matthias Graulich, Eurex. Frank Hayden, Calpine Corporation.
Present. I'm here.
Lindsay Hopkins, Minneapolis Grain Exchange.
Present.
Annette Hunter, Federal Home Loan Bank of Atlanta. Annette Hunter. Vincent B. Johnson, BP.
Present.
Dimitri Karosos, Nodal Exchange.
Present.
Derek Kleinbauer, Bloomberg Seth.
Present.
Laura Klemple, DTCC. Laura Klemple, DTCC. Sebastian Kohling, FIA Principal Traders Group.
Present.
Kevin McClear, ICE. Kevin McClear, ICE. Dennis McLaughlin, LCH Group.
Present.
Craig Messinger, Virtu Financial.
Present.
Dale Michaels, the Options Clearing Corp.
Present.
John Murphy, Commodity Markets Council.
Present.
Christina Norland, Chatham Financial.
Present.
Sam Priyadashi, Vanguard.
Present.
Jonathan Rafe, Nomura.
Present.
Marnie Rosenberg, JP Morgan.
Present.
James Shanahan, CoBank.
Present.
Lisa Shemy, CBOE.
Present.
Betty Simpkins.
Present.
Tyson Slocum.
Yes, I'm here.
Marcus Stanley.
Tom Whiff.
Tom Whip is not on the committee. However, we will circle back to you, Tom, in a second. Marcus Marcus Stanley, Americans for Financial Reform. Okay. Robert Steigerwald, Federal Reserve Bank of Chicago.
Yes, present. Yes, present.
Okay. Janine Tramontana, Federal Reserve Bank of New York.
Present.
Christine Walters, BlackRock.
Present.
Susie White, HSBC.
Present.
Rana Yared, Goldman Sachs.
Present.
Scott Zucker, TradeWeb. Scott Zucker, TradeWeb. Okay, Chair Nadia, that completes your roll call. Oh, I'm sorry. For the interest rate benchmark reform subcommittee members, after I say your name, please indicate that you are present. Tom Whiff.
Here.
Ann Battle.
Present.
Aga Mizra.
Present.
And I believe that we have 3 commissioners on the line or in the room. Could you please say present after I call your name? Commissioner Quintens? Commissioner Quintens? Commissioner Stump?
Present.
Commissioner Berkovitz?
Present.
Okay. Was there
Commissioner
any...
Matthias Graulich is also present. Sorry, you couldn't hear me before. I don't know why.
Okay. Thank you, Matthias. Okay. Chair Nadia?
Thanks, Alicia. So just a few logistical reminders before we get started. Committee members and speakers, if you can please keep your phones on mute during the presentation and refer to the meeting instructions if you wish to make a comment or ask a question. I will recognize the members who wish to speak. If there are follow-up comments or questions after your initial statement, just please be sure to state your name and your firm. The first item on the agenda is a report from the MRAC Interest Rate Benchmark Reform Subcommittee on its work to date. Again, many thanks to the subcommittee and its chair, Tom Whiff, Vice Chairman, Institutional Securities at Morgan Stanley, and Chair of the Alternative Reference Rates Committee for the great work done so far. Tom, please provide your report.
Thank you, Nadia, and good afternoon, everyone. Thank you for making the time for this conference call outside of the normal biannual MRAC meeting schedule. Given the direction of travel and the pace of recent developments, we felt that it was important to get today's agenda items in front of the MRAC in advance of the November meeting. Before we begin, I'd like to note that I will not be commenting on behalf of Morgan Stanley, the ARC, or any other organizations today, and the views that I represent are strictly my own and those of the subcommittee that I chair as previously established by the MRAC. I want to take a moment to thank Commissioner Benham, Alicia Lewis, Nadia Zakir, the MRAC, and the rest of the CFT for the formation of this subcommittee. The transition to alternative reference rates is a massive task ahead of us, and to achieve success, it is paramount that we have close coordination between the public and private sectors. I'd also like to thank the members of the subcommittee for their hard work over the past year. The full subcommittee has now had 3 conference calls, with several more calls and correspondences occurring between the working groups and the dedicated working group leaders. I'd like to begin by first recapping the key developments in the LIBOR transition that have occurred since we last spoke in June, and then discuss our 3 agenda items. The 3 agenda items are as follows. 1, vote on the recommendation of the subcommittee related to plain English disclosure language. 2, discuss proposals from central counterparties regarding adjustments to discounting and price alignment interest. 3, discuss the clearing treatment for certain physically settled swaptions. Developments in the LIBOR transition. Since June, there have been a number of important developments in the LIBOR transition driven by both regulators and market participants. Regulatory developments include the following. FASB voted to provide accounting relief for contract modifications and hedging relationships impacted by the LIBOR transition. The proposal for this relief was issued last week. The SEC released guidance on appropriate disclosures for dealers and investment managers that are trading, investing in, or selling LIBOR-linked products. The FHFA suggested that they will eventually prohibit Fannie and Freddie from purchasing LIBOR-linked mortgages at some point. The Treasury Borrowing Committee noted in their meeting minutes that they are supportive of the U.S. Treasury issuing a floating rate note tied to SOFR, pending further analysis on how this may impact demand for existing U.S. Treasury floating rate notes. IOSCO issued a statement noting that the best risk mitigation to a LIBOR cessation event is moving to RFRs now. This is consistent with the message that the ARC has been delivering for months, that the best way out of a hole is to stop digging. The Financial Stability Oversight Committee discussed the LIBOR transition in their September meeting last week. Just last month, we received the first indication that the U.S. Treasury may have guidance on tax consequences of converting legacy LIBOR positions. We are still waiting to see the final guidance, but this is certainly encouraging. Market developments include the following. The ARC provided additional details on how to construct a SOFR-based ARM product. This is usually significant development for the consumer market and shows how SOFR in its current form can be used for many products. The clearinghouses have come out with initial proposals for how they will adjust discounting and price alignment interest. This will be the focus of much of our conversation today. In discussing our proposals, first, plain English disclosures. The first order of business for today's meeting is to discuss and vote on the plain English disclosure language drafted by the subcommittee. I will let Ann discuss this language in greater detail, but at this point, you should all be familiar with it. Note that this language was drafted by the Disclosures Working Group and reviewed by the broader subcommittee. The key motivation behind this language was to have a standard set of disclosures that market participants can incorporate in their documents that will adequately inform their clients and counterparties about the implications of using LIBOR-based products. They may not be perfect for every market participant, so firms should be encouraged to amend as needed for their respective organizations. For instance, they are written on a transactional basis, but could be provided on a relationship basis instead. Substantively, similar disclosures developed by a particular bank are also fine. However, all traders that continue to engage in LIBOR and other IBOR transactions should be aware of the disclosures or other internal disclosures and should endeavor to ensure that they are distributed to counterparties in an operationally feasible and efficient way. After discussing these disclosures, we would like to initiate a vote by the MRAC to approve this language. If approved by the MRAC, these would be submitted to the Commission for consideration and would be hosted on the MRAC section of the CFTC's website. The second item for today is CCP adjustments to discounting and price alignment interest. Another key focus from the subcommittee has been discussing areas of coordination and potential risk considerations from the current proposals put forth for discounting and price alignment interest adjustments from both LCH and CME. We will hear shortly from Dennis McLaughlin of LCH and Aga Mirza of CME, who will both give brief overviews of their existing proposals. There are certain differences between their respective proposals that the subcommittee recognized as potentially challenging from an economic and an operational perspective. There was desire from the subcommittee for consistency across the clearinghouses in how they approach this adjustment to the greatest extent possible. A few areas of concern were the timing of the adjustments, the pricing mechanism for cash compensation, and the methodology by which ongoing basis risk was compensated. We would like to discuss these issues today, but recognize that the discussion is likely too extensive for a single session, and that ultimately both clearinghouses will enact plans that best represent their clients' preferences. However, the subcommittee would like to gauge from the MRAC on how to best approach coordination between the clearinghouses where possible. Guidance regarding the appropriate forum for these discussions, whether it is within the subcommittee, within the MRAC, or within the CFTC, would be helpful. The subcommittee feels that a larger degree of communication and coordination between the clearinghouses will have a highly beneficial effect on the single-step transition for the market. The third item is clearing treatment for certain physically settled swaptions. Finally, the clearing treatment for certain physically settled swaptions has been a point of discussion in the subcommittee as well as in the broader market. Notably, in the current construct of the single-step transitions at both clearinghouses, there may be valuation discrepancies that arise in these products. I will discuss the mechanics of this issue in greater detail later this afternoon. The subcommittee felt that it is likely too premature to propose any sort of relief to the MRAC, but rather we would appreciate your guidance on how we should approach this issue. It has been suggested by certain market participants that exempting these specific swaptions from clearing mandate could be a solution, though the implications of this have not been fully vetted. CME's presentation shortly will suggest a potential solution to this issue that they will look to gather market feedback on as well. We look forward to introducing this discussion to the public domain and getting your feedback. Next steps. The subcommittee's work will continue after this meeting, and we intend to have another update for this group at the November MRAC meeting. To the extent the MRAC approves the disclosure language today, we would expect to make that accessible to market participants in short order. The plain English disclosures will be posted on the MRAC section of the CFTC site, and supplementary information will be posted on ISDIS site. I expect the discussion of coordination between the clearinghouses on their respective single-step proposals will be ongoing for the next several weeks and months. Pending your input today, we will determine if the subcommittee is the preferred venue for such coordination, or if perhaps November's MRAC or another CFTC forum may be more appropriate. Timely resolution of these discrepancies is important for market participants, as the operational work needed to prepare for this significant change may be time-consuming for many firms. For the swaptions discussion, we will take the MRAC's guidance into how this should be approached within the subcommittee. The ARC is also taking a look at this issue, but ideally we would combine forces with the MRAC to ensure a timely resolution. Depending on the solution reached by the market, there may be significant repapering or operational work ahead for many firms. We welcome any and all feedback from MRAC on our areas of focus that we have discussed today. The MRAC and the CFTC's guidance has been helpful to our work thus far, and we look forward to further collaboration with this group. Once again, I would like to thank Commissioner Benham, Alicia Lewis, Nadia Zakir, and the MRAC for the opportunity to provide this public service.
Thank you, Tom. At this time, I'd like to open the floor to questions and comments from the membership on the report.
Committee members, you have received meeting instructions which indicate how you can ask a question and be placed in the queue. Please refer to that information. Chair Nadia, there appears to be no questions.
Okay. Since there are no questions or comments on the report, I'd like to ask Ann Battle to present the recommendation from the subcommittee regarding the plain English disclosures that have been circulated to the MRAC in advance of the meeting. Ann is the subcommittee's disclosure working group leader and an assistant general counsel at ISDA. For members of the public who are listening on the phone, the voting drafts of the disclosures are on the CFTC's MRAC meetings webpage. Ann, you may please begin.
Thank you, Nadia, and thank you, Tom. Thank you as well to the CFTC, Commissioner Benham, Alicia, and the MRAC for the opportunity to present. As Tom described, earlier this year, the Interest Rate Benchmark Reform Subcommittee formed a disclosures working group to produce plain English disclosures for use by firms that continue to transact in LIBOR. The Interest Rate Benchmark Reform Subcommittee recommends that market participants use some type of plain English disclosures when facing all counterparties with whom they continue to transact derivatives referencing LIBOR and similar IBORs. The proposed disclosures are intended as helpful examples of plain English disclosures that market participants could use as they determine appropriate. For example, the disclosures may be appropriate if market participants do not have their own disclosures or if they prefer to use something that is publicly available and standardized. The proposed disclosures are written on a transaction-by-transaction basis, but could be provided on a relationship basis if that is more operationally feasible. Substantively similar disclosures developed by a particular bank or firm would also satisfy the objectives of the Interest Rate Benchmark Reform Subcommittee. The subcommittee believes that all traders and others who continue to transact referencing LIBOR and other IBORs should be aware of these disclosures or other internal disclosures and should endeavor to ensure that they are distributed to all counterparties in an operationally feasible and efficient way. The proposed disclosures are written so that they are helpful to all market participants, including those who have no knowledge of benchmark reform, existing fallback provisions and derivatives and other instruments, or efforts to implement new fallback language. The proposed disclosures contain 4 options based on 1, whether a transaction references LIBOR, which is expected to cease in the near term, or it references another IBOR that may or may not cease in the near term. And 2, whether the transaction is entered before or after ISDA updates its standard definitions for derivatives to include new fallbacks. For transactions entered before ISDA updates its standard definitions, the disclosures note that despite contractual provisions for attempting to determine a fallback rate, it is unclear what rate the contract would reference if the relevant IBOR is discontinued. These disclosures also encourage counterparties to consider amending their IBOR referencing contracts to include the new fallbacks once those fallbacks are final in early 2020. For transactions entered after ISDA updates its standard definitions, the disclosures note that the fallback rates that would apply upon the discontinuation of an IBOR are inherently different from the IBOR. The proposed disclosures generally warn counterparties of potential economic implications of continuing to transact in LIBOR and other IBORs and mismatches that could occur across derivatives and other financial instruments. The disclosures reflect feedback from members of the Interest Rate Benchmark Reform Subcommittee and the MRAC. In response to this feedback, we specifically revised the disclosures to 1, note that counterparties should consider using an ISDA protocol to add the new fallbacks once those fallbacks are final, but clarify that they would not be required to do so. 2, clarify that counterparties could also seek to enter bilateral amendments to add the new fallbacks as an alternative to using a multilateral ISDA protocol. Note that counterparties should consider tax, accounting, and regulatory implications of continuing to enter transactions referencing LIBOR and other IBORs. 4, recognize that existing derivative transactions do include a process for attempting to determine a fallback rate if LIBOR or another IBOR is discontinued, although it is unclear what the result of that process would be. And 5, note that spread adjustments are contemplated in connection with the new fallbacks to address the inherent differences between the IBORs and the fallback risk-free rates, although those spread adjustments will not perfectly replicate the IBORs on an ongoing basis. Nothing in the proposed disclosures would amend or supersede the terms of any transaction or any related governing documentation. Information in the disclosures would remain subject to the terms of the relevant transactions and documentation governing those transactions. The disclosures are separate and distinct from the more comprehensive disclosures that ISDA has published for use in compliance with CFTC Rule 23.431, Disclosures of Material Information. The Disclosures Working Group of the Interest Rate Benchmark Reform Subcommittee has recommended that ISDA consider updating these more comprehensive disclosures at a later date once ISDA has updated its standard definitions to include the new fallbacks. With that background, the Interest Rate Benchmark Reform Subcommittee recommends, 1, that the MRAC approve the disclosures which may be used by market participants as they deem appropriate, and 2, that the MRAC recommend to the Commission that the Commission consider the disclosures.
Thank you, Anne. Committee members, you have heard the recommendation coming from the subcommittee. Is there a second?
If there are any MRAC members who are on our subcommittee, having recommended that, it would be appreciated if they could second the motion. Alicia, to get the second, someone needs to hit *1. Is that correct?
Yes. And I think we have Marnie Rosenberg on.
Yep, Marnie Rosenberg.
Yeah, I second the motion. I'm having problems. Do you guys hear me?
Yes. Thank you.
Oh, okay. Okay, yeah. I second the motion.
Thank you, Marnie. It has been moved and properly seconded that the MRAC approve the plain English disclosures which may be used by market participants as they deem appropriate, and that the disclosures be submitted to the Commission for consideration. Is there any discussion? The floor is open for questions and comments from the membership at this time. Jim Shanahan, CoBank.
For approval.
Jim, you have the floor.
Frank Hayden, Calpine.
About to vote on. Systemic banks or types of counterparties involved in the plain English disclosures, or is it pretty much universal across all groups of folks doing business under that?
I'm sorry, it was difficult to hear the beginning of your question.
Yeah, so the question is that these recommendations for the IBOR, LIBOR fallback provision language, are they specific to a particular type of counterparty, such as a globally systemically important bank or an end user or a swap dealer, or are they pretty much across the board?
They're across the board, written for market participants, both who are very sophisticated and involved in this transition and those who are not, given that a discontinuation of LIBOR in particular would affect all market participants equally. The disclosure should be appropriate for all market participants who continue to transact in LIBOR.
Okay, thank you.
Sam Darshi, Vanguard.
Yes, hi. Thanks, Nadia, Alicia, Tom, and Ann. I have a question. Can this draft be shared with our respective firms prior to it being published on the MRAC website?
I don't think I think we're hoping to get comments here today. I don't think this is not out for a comment period. I think with the amount of work that went behind it, I think the goal would be if there are particular concerns or considerations. But again, since this is not mandatory by any stretch, or it's really, I mean, the goal here has been from the beginning, as Ann described, the idea to to give people something that they could use to to hopefully, to some degree, for those who like to use it, limit the proliferation of these types of disclosures and get something into the market that we can move out in a reasonably efficient amount of time that would be helpful for people who are not as up to speed as the people on this call. But Nadia, is that correct in terms of just protocol, process and protocol?
Yes, I believe that's accurate. Yes.
Thank you.
I think the purpose here is to go ahead and take a vote on this final draft today. So if there's no further discussion, we will take a vote on the recommendation from the Interest Rate Benchmark Reform Subcommittee that the MRAC approve the plain English disclosures, which may be used, as we mentioned earlier, by market participants as they deem appropriate, and that the disclosures be submitted to the Commission for consideration. As a point of order, a simple majority vote is needed for the motion to pass.
Before we start with the round of voting, I just want to give an opportunity for those members who may have joined the call late to be on the record. Stephen Berger, Citadel?
I'm here. Can you hear me?
Yes. Isaac Chang, AQR Capital Management? Okay. Annette Hunter, Federal Home Loan Bank of Atlanta? Laura Klemple, DTCC? Marcus Stanley, Americans for Financial Reform. Scott Zucker, TradeWeb. Scott Zucker, TradeWeb. Well, Scott has sent an email that he is on the call. So.
Yeah, I'm present.
Okay, thank you.
All right.
All right, so we have 32 members present, so I'm going to go through, and please indicate your agreement with aye or disagreement with nay, or abstain if you're abstaining from the vote. Okay, Salman Benai.
Aye.
Salman Benai votes aye. Stephen Berger.
Aye.
Stephen Berger votes aye. Lee Betzel.
Aye.
Lee Betzel votes aye. Biz Chatterjee.
Aye.
Biz Chatterjee votes aye. Alicia Crichton.
Aye.
Alicia Crichton votes aye. Matthias Graulich.
Aye.
Matthias Graulich votes aye. Frank Hayden.
Aye.
Frank Hayden votes aye. Lindsay Hopkins.
Aye.
Lindsay Hopkins votes aye. Vincent Johnson.
Aye.
Vincent Johnson votes aye. Dimitri Karousos. Dimitri Karousos. Derek Kleinbauer.
Aye.
Derek Kleinbauer votes aye. Sebastian Coling?
Aye.
Sebastian Coling votes aye. Kevin McClear?
Aye.
Kevin McClear votes aye. Dennis McLaughlin?
Aye.
Dennis McLaughlin votes aye. Craig Messinger?
Aye.
Craig Messinger votes aye. Dale Michaels?
Aye.
Dale Michaels votes aye. John Murphy?
Aye.
John Murphy votes aye. Christina Norland?
Aye.
Christina Norland votes aye. Sam Priyadashi?
Aye.
Sam Priyadashi votes aye. Jonathan Rafe?
Aye.
Jonathan Rafe votes aye. Marnie Rosenberg?
Aye.
Marnie Rosenberg votes aye. Jim Shanahan?
Aye.
Jim Shanahan votes aye. Lisa Shemme?
Aye.
Lisa Shemme votes aye. Betty Simpkins?
Aye.
Betty Simpkins votes aye. Tyson Slocum?
Aye.
Tyson Slocum votes aye. Kristen Walters?
Aye.
Kristen Walters votes aye. Susie White?
Aye.
Susie White votes aye. Ronna Yared?
Aye.
Ronna Yared votes aye. Scott Zucker?
Aye.
Scott Zucker votes aye. Nadia, it's basically unanimous.
Okay, great. The ayes have it, and the motion has passed. The plain English disclosures have been approved by the MRAC and will be submitted to the Commission for consideration. The next item on the agenda is the CCP proposals for transitioning, discounting, and price alignment interest to the secured overnight financing rate. I will turn it over to Tom to introduce the topic and speakers.
Thank you, Nadia, and thank you to Ann, the working group, the MRAC, and all involved in this work. I think these plain English disclosures will go a long way in this transition and ensuring that people in the market understand the consequence of this work. Thank you very much for all involved, and thank you, the MRAC, for your support. We are now going to move to the views of the subcommittee on a single step. We will introduce first Dennis McLaughlin, Chief Risk Officer of LCH, and he will be followed by Aga Merzer, Managing Director and Global Head of Interest Rate Products at CME, who will discuss their draft proposals for a single step change in discounting. Dennis, we'll pass to you to start it off. Dennis McLaughlin. While we're waiting for Dennis, I would also note that the proposals from both CCPs are on the MRAC website for those playing along at home.
Dennis, the floor is open.
Hello?
Yes, we can hear you, Dennis.
Okay, thank you. So the end of July this year, LCH sent out a document which, after a membership consultation at the end of last year, laid out the approach that the clearinghouse was going to take to the transition to U.S. dollar SOFR discounting. So that was an extensive consultation, and one of the key takeaways from that consultation was that the majority of the members preferred Q3 period to make this transition. So specifically, we came back with a target date of October 17, 2020 as being the date which satisfied most of the members who had partaken in the consultation. The scope is for all U.S. dollar discounted positions in SwapCare, including non-deliverable currencies. So this will include some emerging market currencies because it's quite and these are non-deliverable, because it's quite a logistical undertaking to try and manage dual discounting at the same time. So it'll be a big bang move. That's the plan. The conversion process is planned to be a combination for clients where they can elect cash-only compensation if they choose via clearing broker, and the cash option is available only to clients. And then for members that are typically banks, there's a risk compensation in the form of compensating swaps to be made, and each compensating swap would be a standardized Fed funds versus SOFR basis swap on one of the major benchmark tenors. Now, the exact mechanism for how this will work is still under discussion, and I would encourage anybody who has firm opinions about what's going on or ideas about what to do in more detail to send in comments to the address sofer@lch.com, and we would specifically welcome especially member consultation comments, but also anybody who has any ideas and they might present a point of view that's useful. The coordination with bilateral trades, certainly any U.S. dollar cleared by LCH after the conversion date will, from the point of view of clearing, be discounted at SOFR, irrespective of whether it originates from a swaption contract. The compensation process will only apply to swaps that are registered to LCH before the conversion date, and LCH is supportive of any industry standard for bilateral compensation to be established for counterparties to pay or receive compensating amounts in swaption contracts. But any such process will ultimately need to be agreed between the bilateral counterparties to the original trades. That's the main idea. There will be an auction. The plan is for an auction just a day or two before October 17th to facilitate the cash-only election. And as I said, further consultation is going to be sought on the precise mechanism. So that's just an overview of what we're planning to do. There is a paper that has been hopefully included in this pack, which lays out which is actually the member communications from July 26, 2019, which laid out the approach and asked for the consultation. Thank you.
Thank you very much, Dennis. And we're going to ask if people could reserve their questions until we've heard from both clearinghouses. So, again, thank you very much, Dennis, for that presentation. And we will now pass the floor to Aga from the CME.
Thank you, Tom, Alicia, Chair Nadia, and Commissioner Benham, and the MRAC for the opportunity today to provide an overview of CME's proposed approach. This is to achieve the single-day discounting conversion from effective Fed funds to SOFR for legacy cleared swaps in furtherance of ARC's phased transition plan. CME's currently proposed approach, which I will outline shortly, is very much the product of a thorough consensus-building exercise. Throughout 2019, we have conducted over 100 unique client meetings to discuss every element of our proposal. In addition, we have presented our proposed approach and frequently provided updates to the ARC's Market Structure and Phased Transition Working Group. Our current proposal reflects the consensus opinions of our clients on how to best facilitate the discounting and price alignment transition while ensuring the principles of maintaining market stability and promoting effective risk management during the transition to risk-free rates. Please note that our proposal is still marked as a draft and it's available online, and as such is subject to change based on additional market participant feedback. Our approach is as follows. The scope of our discounting change reflects a phased approach. Our proposed July 2020 transition would be limited to cleared U.S. dollar interest rate swap products, excluding CME-cleared SOFR swaps that are already in SOFR price alignment and discounting environment. We are currently reaching out to our clients in regards to other products and currencies discounted in Fed funds. Timing for our discounting change is currently proposed to occur over the weekend of July 17, 2020, which was chosen based on client feedback and with consideration for the uncleared margin rules Phase 5 implementation in September 2020 and the U.S. presidential election in early November of 2020. Process would occur entirely over a weekend period and would include what CME refers to as cash compensation and discounting risk exchange elements. To eliminate the transfer of value associated with this change, CME would make a cash adjustment at the individual swap level that is equal and opposite to the change in each cleared swap's net present value specifically attributable to the discounting change. Regarding discounting risk exchange, to mitigate hedging costs associated with this transition, as well as the sensitivity to closing curve marks on the proposed date of July 17, 2020, CME would book a series of Fed Funds SOFR basis swaps to participant accounts. These swaps would restore participants back to their original risk profiles and be booked at the July 17, 2020 closing curve levels and will result in an NPV or net present value of $0 for the basis swaps. Discounting risk exchange is a topic that was thoroughly discussed during our client outreach efforts, and CME received feedback from buy-side and some other participants who typically do not hedge discounting risk and therefore may not wish to hold resulting Fed Funds SOFR basis swaps. These clients expressed that they would be interested in an auction service that enables them to exit these positions in a transparent manner. CME intends to engage third-party providers to facilitate such an auction for any participants interested in such a service. Finally, to address the treatment of legacy swaption exercises going forward after our single-day discounting conversion, CME is proposing to offer a service which would facilitate a standardized compensation methodology for swaption exercises which were executed under the premise that the resulting swap would be centrally cleared in a Fed Funds discounting regime. Such swaps would be flagged via a new field provided by affirmation platforms. This would allow counterparties to signal for CME to calculate the difference in value between SOFR and Fed Funds discounting and settle a corresponding cash compensation adjustment. CME believes this approach provides counterparties the flexibility to either negotiate bilateral compensation agreements or utilize CME's proposed standardized compensation methodology. CME fully supports efforts to promote liquidity in the SOFR benchmark. We are very pleased that CME SOFR futures open interest recently reached a milestone of $1 trillion of representative notional. We believe the single-day discounting conversion will further enhance liquidity throughout the entire SOFR curve, and we are appreciative of the opportunity to partner with the industry to solve this complex problem. Thank you, Tom.
Thank you, Aga. Tom, could you please provide the subcommittee's view on the proposals?
Yes, thank you very much, Nadia. On our most recent call, the subcommittee received updates on the current proposals as we have today from both LCH and CME. We then did, at that point, ask the clearinghouses to exit the call so we could discuss our collective views candidly without them being part of the conversation. The key differences noted from our group were obviously, number one, timing. The CME is proposing July 2020, and as you've heard, the LCH is proposing October 2020. The second was the pricing mechanism. CME is proposing using its standard end-of-day pricing to run valuations under effective Fed funds and SOFR PAI and discounting, while LCH is proposing an auction similar to the procedures it would run to close out positions in a default. Basis swap allocation being the third. CME allocates basis swaps to all parties and allows them to manage or dispose of this risk as they see fit, whereas LCH allows client accounts to opt out of receiving basis swaps. It was the view of the subcommittee that it would be highly beneficial to the market if the clearinghouses were to be more aligned on these key issues. and including both the timing and the overall compensation mechanics where possible. It was brought up on our call that keeping significant differences between the respective single-step plans could pose certain risks to the market. To get input from the MRAC, we would like to pose the following discussion questions and open this up to the group. First, do you think it would be beneficial to market participants if the clearinghouses executed their respective single-step transitions at or around the same date? 2, operationally for your firm, what length of time between the two single-step transitions is sufficiently small to minimize or mitigate operational risk? 3, do you think it would be beneficial to market participants if the two clearinghouses executed their respective single-step transitions with similar compensation mechanisms? And 4, as it relates to risk compensation basis swaps, what issues do you foresee for your firm with respect to either of the current proposals? So we would, I think, open that up to the group. Now I'll pass back to Nadia.
Thanks, Tom. We'll now open the floor to questions and comments from the membership. The members, please refer to your instructions on how to pose a question, and we will maybe just pause for 30 seconds or so to give folks time to line up in the queue. Okay, Biz Chatterjee, Citigroup.
Thank you, Nadia, and thank you to Alicia and Commissioner Benham for giving us an opportunity. Nadia, if I could, I'll probably just try to summarize the 3-4 main points that Tom laid out. And recognizing that Citi has a large presence both on the market making or the house account side as well as on our client and our client clearing franchise, I think we have to be careful about making sure we represent both views. I think from our market making perspective on the issue of timing, while we may not have a strong preference, we think from the client side, there may be more interest from clients to closely align both dates. So, that should be probably, a strong consideration as to the preference of our clients. On the operational front and timing, we don't think there's a sufficient or that's a large concern for us. On the front of the present value and the compensation mechanisms, we are broadly supportive of using hedges and a PV cash maven. We think it, has impacts and it reduces reliance on how you have to map curves, especially if you are using longer dated contracts and longer dated curves. Overall, I think if there's a conceptual alignment between the clearinghouses, it definitely is beneficial to the marketplace. There may be parties that have offsetting positions, or at least across parts of the curve, so it probably definitely makes sense to have some kind of alignment in the approach. Net, I think our main focus is we're broadly supportive of using basis swaps.
Thank you, Biz. Our next comment is from Marnie Rosenberg, JPMC.
Thank you, Nadia. Thank you, Alicia Lewis, and thank you, Commissioner Benham, for hosting this call today. I guess like what Biz spoke about and Citi, obviously JP Morgan is a major dealer and clearer in the market. And I'll just present our views based on the questions that Tom posed. So the first question, do you think it would be beneficial to market participants if CME and LCH executed their single-step transitions on around the same date? Yes, we do. We think it actually reduces operational risk to be done on the same day. We prefer the October date that LCH has proposed. not only from an operational risk perspective, but as Biz just mentioned, from a liquidity perspective, there could be offsetting trades which could be moved together. We also think that products with discounting off of Fed funds should be moved together where there's overlapping clear products, particularly. In terms of compensation mechanisms, we think to the extent that the compensation approaches, both from a risk compensation and cash compensation approach, it would be very helpful for the market to work towards, a single methodology on both fronts. And in terms of the specifics on risk compensation and issues, we think it's best to discuss in a broader group of market participants that are focused on this, along with CME and LCH. Thank you.
Thank you, Marnie. Stephen Berger, Citadel.
Thank you. So I'll go through the questions in the same order as the previous commenters did. So yes, we do think it would be beneficial if the two CCPs executed their transitions at or around the same date. So would like those two dates brought much closer together. Operationally, we think within a week would be best. It doesn't necessarily have to be on the same day, but definitely within a week of each other would be preferable. We do think it would be beneficial for the two CCPs to do the transitions with similar constant compensation mechanisms. So we have a strong view that it would be unnecessarily complicated otherwise. And then with respect to risk compensation and the basis swap question, I think there are a number of challenges and risks we see there that need to be carefully thought through. Any auction process in this space is, I think, going to be challenging because you're going to have a lot of people, you're going to have a lot of one-way kind of flow coming into the auction, which I think is going to make finding like the equilibrium price challenging and divergent from what expectations might be. And it's just not clear like that there's going to be a market right off the bat for the new basis swaps. So prices could move a lot even right after the auction. And I think there are a variety of client segments that don't have a lot of experience trading basis swaps. And so I appreciate that one of the approaches is to have a cash-only compensation mechanism, but that may not be universally used by everybody. So, and then I think, going down the road, if you have like a 30-year basis swap and you want to be able to trade out of it, there's a question in terms of like how many counterparties are really going to be there to do those trades. So, I think on the risk compensation front, there's still a number of issues that we need to think carefully through.
Thanks, Stephen. Rana Yared, Goldman Sachs.
Hi, good afternoon, and thank you for your time. Taking the questions in order as the previous group has done, we think that there's benefit in having the two conversion dates aligned. We have a preference for the July date because we think that the sooner that the date takes place, the greater support can be provided for SOFR in terms of liquidity in the marketplace, and we view that to be the ultimate end goal of everyone involved in moving towards the risk-free rate, which is the provision of liquidity for the ultimate rate. On the question of mechanism, we would also have a preference for similar compensation mechanisms and agree with a comment that was made that an auction mechanism could potentially be challenging due to the one-way market, with mostly non-direct members opting to not take the basis swaps option. And so in the event that there is an auction mechanism, there needs to be a contemplation, as Marnie said, in a larger group around what would happen if there's no one on the other side.
Thank you, Rana. If there are no further comments or questions, this concludes our discussion regarding the CCP proposals for transitioning PAI and discounting to SOFR. Many thanks to our speakers.
Nadia? One moment. I just want to give Dennis and Aga and Tom an opportunity to respond to what they've heard so far, if there's anything.
Yeah, this is. I'll start here. I think this is Tom. I think what we're hearing is, I think, very consistent with what we've heard at the subgroup, that there is a desire for consistency where possible, and obviously a desire for complete consistency if possible. I think where we will be left in next steps is where, in fact, is an appropriate place for that conversation to occur. It's very clear, I think, that what we're hearing from the market participants on this call, as well as the subgroup and those who have spoken up, we haven't heard much to the, if anything, to the contrary. So I think we've got plenty to work with. I think the clearinghouses have plenty to work with. My open question, I think, which I think will be the next step for all of us to consider, is where, in fact, could those conversations occur in an appropriate venue with obviously a clear eye on antitrust concerns. So I will pass it back, Alicia, Nadia, back to you, and let's see what we hear from Dennis and Aga.
Dennis and Aga, if either of you have any further comments, the floor is yours.
Thank you, Nadia. This is Aga Mirza from CME Group. I just would like to reiterate that in the light of the comments that were made, that we are fully supportive of an approach that is aligned between the CCPs. If you look at our current proposal available online, it is clearly marked draft and reflects the input and insights that we received through our 100-plus client meetings thus far. Having said that, we continue to have additional client meetings and would be very much open to receiving feedback and accommodating market and client preferences. Thank you.
This is Alicia Lewis. Just wanted to remind everyone that you can still provide comments to the email addresses that are on the draft of the proposals. So comments can be still directed to those email addresses.
Okay. If there are no further comments, again, many thanks to our speakers. The last item on the agenda is a discussion regarding the clearing treatment for certain physically settled swaptions. I will turn it back over to Tom.
Thank you very much, Nadia. As we know, we're going to try to discuss this issue. It is, we believe, something that has been developing, but not necessarily, we're looking for just some guidance from this group, but understanding that this is fairly early in the process. As you know, most swaptions in the market trade bilaterally and are not cleared, and because of this, their present value is generally calculated as a series of outcomes and rates discounted to present day using a discount curve agreed upon by the counterparties. This can vary across market participants, but for the most part, U.S. dollar swaptions will be discounted with Fed funds. To the extent these options expire in the money, they will often be settled physically in the form of swaps as opposed to cash settled. These swaps are subject to CFTC's clearing mandate, and assuming there is no pre-existing reason for the swap to be exempt from these requirements. In the current discounting and price alignment interest environment perpetuated by the clearinghouses, these cleared swaps are discounted at Fed funds too, so there is a match between discounting curves for the bilateral option and the cleared swap upon settlement. However, a potential issue arises if a single-step transition occurs in the clearinghouses and they begin discounting these settled swaps with SOFR because the original swaption was priced with the assumption that Fed funds would be used as the swap's discounting curve. Importantly, in this scenario, the swap would appear to the clearinghouse to be a new trade instead of a physical settlement from a legacy swaption. Thus, it would not be eligible for cash or risk compensation. This is different from legacy swaps that would be eligible for both cash and risk compensation under the current single-step proposals. Another example that's been discussed in the market is if you have a swaption that is very deeply in the money, such that it trades quite similarly to a swap, a market participant wished to hedge that delta risk on this swaption by using a cleared swap. When the single-step date occurs, the cleared swap hedge will be eligible for cash and risk compensation, but the option will not be eligible for such compensation upon expiry. And these two products, which mirrored each other closely, would now have a valuation discrepancy that did not exist prior to the single step. Neither the subcommittee nor the ARC have reached a conclusion about the best risk management strategy for this issue, though the topic has been discussed to some degree at both forums. One idea that has been suggested elsewhere in the market is that if the CFTC provided relief from the clearing mandate for physically settled swaptions, swaps could be booked bilaterally upon expiry and thus be discounted with the same dealer curve as the original swaption. Our subcommittee has not vetted the benefits and considerations of this approach, so at the moment cannot endorse such a recommendation. Another possible solution is from, I think, the recent CME proposal, where they suggest clearing members can identify swaps that are the result of swaption expirations, and the clearinghouse can distribute cash compensation accordingly. The subcommittee, again, feels it is too premature to endorse any solution at this point, but we welcome your guidance on whether or not this is an issue that should be a key part of our work over the coming months. To get input from the MRAC, we would like to pose the following discussion questions. 1, do you view the potential valuation differences that may result in physically settled swaptions vis-a-vis discounting risk to be an issue for your respective firm or your clients? 2, do you think the subcommittee is an appropriate venue to discuss this issue? And if so, do you think that a request for targeted clearing relief from the CFTC should even factor into the subcommittee's discussions? And we will then open up that for any comments on this topic, although we do, as we said earlier, this is a developing topic.
Thanks, Tom. So at this time, I'd like to go ahead and open the floor to questions and comments from the membership. Why don't we start with Frank Hayden, Calpine?
Can you hear me?
We can hear you.
Okay, so my question was really, maybe, just taking a step back, thinking about the margining process and, how risk is calculated on positions at the exchanges and how, that spam calculation kind of encourages companies to, either pony up more money to support the trade they're in or actually to exit the position. And I'm kind of curious, given that we know that LIBOR is dying, I'm kind of curious if there's some thought being put into the basic risk calculation on clearing these sorts of products that have this legacy IBOR type index, and if in fact, if that could in fact be kind of like a stick to encourage people to start putting on, basis trades between SOFR and LIBOR to kind of create, so some liquidity would develop, because obviously, given the comments in the earlier section with regards to, the auction being one way, and obviously given the comments around the dates and people kind of concerned about summer liquidity, fall liquidity, people being around, it seems like there should be some signals put into the marketplace to start encouraging people to start thinking about these sorts of risk, other than just, sending out advisories and notes and fallback provisions that they may or may not even look at. I'm just curious from an exchange perspective if something's being done with regards to the margining calculation for these dying instruments, if you will. Thank you.
So thanks, Frank. Before I move to the next question here, Tom, did you have any reactions to that?
I think it's a very appropriate question. I think maybe we should see if the clearinghouses have some views on that particular aspect of this work.
Okay, so let's move. let's move to the next question here.
We can. I mean, we as a subcommittee. I'm sorry, Nadia. We as a subcommittee, we can take that question under advisement and then and be able to respond back to this committee.
Yeah.
Thank you.
Okay, great. Thank you, Tom. So let's move to Biz Chatterjee at Citigroup.
Thank you, Nadia. I think I think Tom's comments at the start of the discussion are interesting, because I think from our perspective we view this as a kind of a developing area. The subcommittee certainly feels like a right place where we should have some of these discussions. In our overall perspective, I think there's both legal and risk considerations we need to look at, and so to the extent that there's an industry or a CCP-led solution, we're happy to see if that develops. On the issue of relief, I think one of the things to consider is that a lot of people or a lot of people in the industry may have entered into these transactions with a certain amount of assumptions about the clearing supposition. If you change that and these things now end up being not cleared, I wonder if participants have to factor in the other associated issues like capital and other things that happen from cleared versus non-cleared considerations. And obviously there's the margin issue as well. So the issue of relief for margin, again, on uncleared or legacy swaps has been previously discussed in the subcommittee and the larger MRAC as well. So I think this issue certainly needs a lot more thought and debate before we kind of jump to a regulatory ask for exemptions.
Thank you, Biz. That's helpful, and I think we tend to agree as well that there's quite a bit of work that we still need to do in the context of swaptions. We do think that the subcommittee could very well be a very good forum for that discussion to occur and for there to be solutions, especially given that there may be, may or may not be a need at some point in time for further action from the Commission as well. So certainly I think that would be something that we would like to continue to observe and evaluate. Our next question here, Marnie Rosenberg, JPM.
Hi, yes, just going through Tom's two questions. Yes, we do think there's potential valuation differences on these products that will be an issue for our firm and all firms that trade swaptions and that result in physically settled swaps. We do think this is still a emerging issue that needs to be sorted out. There could be multiple solutions, and we think it's premature to request for no action relief from clearing the physically traded swaps. We also think that it would be best if market experts who trade swaptions in their respective firms have a forum to sort these out, what the potential solutions are and the pros and cons of each. My understanding is there have been discussions about setting up a subcommittee under the ARC, under the market structure working group to handle this, and we would be supportive of that, and then potentially coming back to the benchmark subcommittee with the results of those discussions, and then making a determination as to what the recommendations could be that would be put forth to the full MRAC and the CFTC. Thank you.
Thank you, Marnie. Stephen Berger, Citadel.
Thank you. So I think I'll be echoing some of what we've heard from a few of the other responders, but yes, we do see potential valuation differences here, and so I think this is an issue that does warrant further attention. I think it's good that the subcommittee is bringing this up for dialogue. Whether it's the exactly appropriate venue to weigh in on it, I think is an open question, but it certainly is doing a good job by drawing attention to the issue of providing some thought leadership here. So I don't know if the subcommittee could organize some sort of consultation where the market experts could weigh in, or whether it is through the working group, the ARC market structure working group that was just mentioned. But I do think we need to have people who are trading these products day in and day out involved in the discussions. And I know we've got folks who are willing to do that. And at this point, I think I agree with what some of the other commenters said, that I think it's probably at a minimum premature, if not just not advisable in the end to seek clearing relief in this instance. So we think that would potentially fracture the market, create some risks of cherry picking in terms of who takes the cleared versus uncleared swap at exercise, and would create challenges with respect to hedging the products if it were going down the uncleared route. So anyway, we look forward to continuing to engage on finding the right solutions here.
Thanks, Stephen. Lee Betzel, CME Group.
Oh, hi, thanks. I just wanted to go back to the question that was raised, I believe, by McAlpine at the beginning of this discussion topic in relation to using margins on exchange for potential sticks or, I suppose, carrots in incentivizing the move. And I just wanted to make the comment that, generally speaking, we see appropriate margins as being reflective of the actual risk in the positions and liquidity in those markets. Not sure that it's appropriate to use that as an incentive or a stick. I would say that if we see liquidity in LIBOR-based contracts disintegrating, then of course that would be reflected in our margin setting. So I just wanted to make that general comment.
Thanks, Lee. So if there are no further comments or issues for discussion on this topic, Tom, could you please discuss the subcommittee's next steps?
Yes, thank you, Nadia. I think the subcommittee obviously our work will continue after this meeting, and we intend to have another update for this group at the November MRAC meeting. Just to recap what we've seen here today and heard here today, given the MRAC's approval of the plain English disclosures earlier, we hope that and that gets passed on to the CFTC. It would be helpful to make that accessible to market participants in short order. Again, I think there's a real belief among the subcommittee that having many bespoke disclosures is probably not helpful, and to the extent that this plain English disclosure is helpful for market participants broadly, we think that would be a positive, and sooner rather than later on that. And when they are posted on the CFTC site, and the supplementary information we post on the ISDA site when all that takes place. I expect that in terms of the discussion on coordination between the clearinghouses, I think we heard very clearly from the subcommittee, as well as what we've heard on this call, that there is a great desire for consistency. I think what we need to contemplate is our takeaway is to have further discussions on where that could actually take place and what is the best venue. Again, that would have a major focus on potential antitrust issues, but also being very focused on what we've heard of the financial stability issues in terms of getting this process as most consistent as possible. For the swaptions discussion, I think we've heard loud and clear that there's more work to do. I think we can take that back to our group. We can, really work on this. But certainly, I suspect that knowing that the ARC is also focused on this, we will also refer to our original guidance from Commissioner Benham that our group here is to be additive and not to duplicate work. So we will ensure that wherever this lands and wherever this topic it gets the best focus and the best chance for a reasonable outcome, we will stay very close to that. In the meantime, I think that one's a little bit too early to report back on, but I think we've heard pretty clearly that it is an issue. It needs to have some form of resolution. There are a couple of ideas out there, but we will be very certain to stay very, very close to the ARC on this one and ensure that, again, that our work from our subcommittee is additive to that and accretive to that work if, in fact, it takes place at the ARC. From there, I think, we've got plenty to work with here. We will reconvene the subcommittee and take this all back. Again, our big open question is what is the appropriate venue that the clearinghouses could actually have productive discussions around this call for consistency that we've heard here today from the subcommittee and from those who spoke up on the call. Besides that, I think we've got plenty of takeaways, and we again thank everyone for joining this off-cycle call and the opportunity to actually put this all together. We thank Commissioner Alicia, Nadia, the subcommittee, MRAC, and all involved in this, and everyone at the CFTC. Thank you very much, and I will pass back to you, Nadia.
Many thanks to you, Tom, and your leadership, as well as the members of the subcommittee, and including Matt Oakes for your hard work. We certainly look forward to hearing more about the subcommittee's efforts at our next meeting. This concludes the business part of the agenda.
This is Alicia Lewis. Before we go to closing remarks, I'd like to get those members who may have joined the call late on the record as having attended. So, Isaac Chang, AQR. The lines are open. Isaac, are you on?
Yes, I'm on. Sorry. Yes.
Okay. Thank you. Annette Hunter. Unmute your phone, Annette. Annette Hunter. Well, Annette has indicated via email that she is in fact on the call. However, we cannot get her on the record right now. Laura Klemple, DTCC.
Yes, I'm on, Alicia.
Thank you. Yes, we got you. Kevin McClear, ICE.
Yep. Hi. Thanks.
Thank you. Marcus Stanley. Okay. Well, those were the individuals who we wanted to get on the record. Well, it is now time for closing remarks from Commissioner Benham.
Thanks, Alicia. I really don't have much else to say other than reiterating what Tom said in his closing. Tom, to you, thanks again for all your leadership as chair. This is great work. Special thanks to Alicia and Nadia for their continued contributions and organization. I want to thank the CFTC tech team who's in front of me right now. These meetings are always a little bit tricky, but they pulled it off really well. And thanks to Ann, Aga, and Dennis for your contributions, all of the questions, for everyone on the committee and the subcommittee. We're fast approaching 2020 and the months and weeks are going by. This is a huge issue. These are small pieces of a larger puzzle that I think these contributions will have a tremendous value add as we work closer to 2021. And as Tom said, I've said repeatedly, we're working with our colleagues in both the official sector and the private sector to make this as seamless as possible. And be a value add to the larger ARC contribution. So with respect to the disclosures and the discounting adjustments and the swaptions, I think we heard a lot of consensus, a lot of great questions, which hopefully the subcommittee will take back and work from and create better work products down the road. Lastly, I just want to thank my fellow commissioners who are here. And I've heard a lot over the summer as we've had a transition. I knew the new chairman is thinking about LIBOR extensively, and as he gets settled, I know we're going to start to respond to some of the regulatory relief that was requested last year, and some of his larger policy priorities and how we as the commission are going to address these very challenging issues. But we are here, we're available, and we understand the import of all of this and the fact that we are a part of this exercise and need to be working with you and making sure that we're providing appropriate guidance and making sure that the markets transition smoothly and in a transparent, safe, and well-functioning way. So thanks again to everyone for your time, and look forward to future conversations.
Thank you, Commissioner Benham. I want to thank everyone for attending this meeting and also give a friendly reminder that the nominations for the Climate-Related Market Risk Subcommittee are due today and should be submitted to the MRAC submissions email address set forth in the Federal Register release. And this meeting is now adjourned. It is 4:26.